Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look more deeply at just how overvalued New Zealand's housing market is and how much prices might fall. We'll check out the latest news on consumer confidence, and it's not good, unfortunately. And finally we'll look at the extraordinary collapse in the value of Macquarie's Fortress notes. The debate about what will happen to house prices has been a regular over barbecues up and down the nation through this endless summer. Now we have some statistics from Barfoot and Thompson showing house prices beginning to fall quite sharply in Auckland, and sales volumes are crashing. This has quite rightly raised the question, how much might house prices fall? The next question to ask is, how overvalued is housing in New Zealand? There's a couple of ways to approach this. The first way is to look at housing affordability. Interest.co.nz produces the Fairfax Media Home Loan Affordability Survey. Now it looks at the percentage of after-tax income needed to afford the home loan on a median house. The survey shows that nationally it currently takes 81.9% of take-home pay on a median income to afford the loan on a median property, and that's with a 20% deposit and an 80% home loan. If wages were to keep growing at current rates, and if interest rates were to stay the same, then house prices would need to drop 30% to get that affordability ratio back down to the 40% level most bankers say it should be. That would mean the median house price would have to drop from around $345,000 now to around $240,000, perhaps by the end of the year. Looking at it another way, this chart shows the trend for the value of New Zealand's housing stock. It's clear the market just took off in 2002 and is now at least 40% overvalued by comparing current housing stock values with the trend over the last 28 years. In other words, the boom is about to bust in a way we've never seen before in New Zealand. Briefly, let's look at the latest on consumer confidence from a Roy Morgan survey conducted in early February. Consumer confidence fell to a 4-month low, but more importantly, confidence about buying a major household item has slumped to a record low. This will make life difficult for appliance and other major item retailers and give some reassurance to the Reserve Bank that retail spending is under control and may help take some pressure off domestic inflation. We get the Reserve Bank's next decision on interest rates on March 6. It will probably be making its decision just after the Australian Reserve Bank has hiked interest rates across the Tasman. Now let's look at the extraordinary collapse of Macquarie New Zealand's Fortress notes. Late on Monday, Macquarie announced that the net asset value of these Fortress notes had slumped another 17 cents to 35 cents. For New Zealanders who invested $28.7 million in these notes in May 2005, this means they have lost 65% of their capital. So much for the word fortress. This latest collapse followed the forced sale of loans underneath the trust for Fortress. This fire sale wiped 17 cents from the $1 face value of the notes in one fell swoop. But investors are not out of the woods yet. It may actually get worse. Macquarie said the current market value of the portfolio was $372 million US, and this value had been used in calculating the estimated net asset value of 35 cents. But it also said it would not be able to realise that market value if it had to liquidate the portfolio now. That's how bad the markets are. More ominously, Macquarie said it was trying to refinance the loans, but it may not be able to do so. The Macquarie Fortress notes were set up as a leveraged play on senior loans. These are described as loans made to corporate borrowers to finance acquisitions, share buybacks and internal growth. These loans are said to be first ranking and secured against corporate assets and cash flows. The idea is that investors would receive a return equal to the bank bill swap rate plus 4.5%. Sounds like a good idea. These markets for senior loans to mostly American companies were supposed to remain liquid and be viewed as relatively safe. Good idea when markets are in turmoil, but right now they are in turmoil. When Macquarie launched the product in 2005, it also touted the credentials of its subcontracted fund manager, Four Corners Capital Management, which is based in Los Angeles. Four Corners says it specialises in creating and managing alternative fixed income investment products, and it has a particular expertise expertise in below investment grade and structured finance markets. Yikes. But these markets for M&A debt have seized up in recent days, and this is the most direct example yet of where New Zealand investors have been hurt by the international credit crunch and the fallout on American markets for subprime and structured debt instruments. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Wednesday.